Good morning, everyone. Welcome to today's session of the Genghis Weekly Investor Briefing. We're glad you could join us. I'm Dora Mbaya and I'll be your host today. So thanks to our research analysts, we'll get an overview of the equities and fixed income markets, as well as any updates on the financial and the banking industry. We value your active participation, and so feel free to use the Q&A tab to send in your questions and we'll tackle them at the end of the presentation. Over to you, Melody.
Thank you, Dora. Good morning, everyone. Just a minute, I share my screen. Has it come?
Not yet, Melody, but it's about to.
Okay.
Yeah, we can see it now.
Okay. Thank you, everyone, for joining us today and taking your time to be with us. So I'll just start off with a look at the macroeconomic review. So the PMI was released last week. That's the Purchasing Managers Index. So it expanded to 51.4 from 50.4 in the previous month. So this index points to an expansion or a contraction in the private sector. Business sentiments, if it's below 50, it's a contraction. Above 50, it's an expansion. So the output index, which has about a 25% weighting, improved for the first time in 5 months as business spending normalized following the pandemic measures that were put in place by businesses. Also, there was increased spending by customers, and because of improved conditions, new orders also went up, achieving the highest growth rate since May 2021. However, the future outputs index, which looks at the forecasted outputs, remains weak. It remained weak in October, mainly due to the uncertainty that's going on because of the pandemic. Additionally, producers passed on the higher costs to their clients. That's because of things like to do with rising fuel and higher VAT, and also because of the supply bottlenecks that you've seen is affecting most or all countries. We can see now that is pushing prices higher, meaning that producers have to pass the price to its consumers. Just a side note, the CBK released its data on the amount of cash handled by mobile money agents, and it had gone up by 41.5% year on year, and that's till September 2021. So in addition, also the number of agents rose by about 16.2%. So this is in line with the growing demand for mobile money services. So we attribute this to mainly the rise in business activity, as we've seen, and also just the growing preference for alternative banking channels. Also now the way with the curfew lifted and improved operating hours, we're going to see some improvement in business activities. Additionally, just a side note, the IMF in October, in its regional economic outlook, downgraded the 2021 GDP forecast for Kenya to 5.6% from 7.6. So at the same time, the fund upgraded its 2022 forecasts to 6% from 5.6% earlier. So despite this downgrade, there's an overall optimism of just a better outlook in the year. So we recall that in September, the CBK governor projected 6.1% growth rate for 2021 and 5.6 for 2022. The World Bank, on the other hand, it projected 4.5% and 4.7 for 2021, 2022 respectively. Treasury, it was about 6.6%. So this rate of 6.6% is what the Treasury used to lay out its expenditure plan for the current year. So basically, we would say that optimism is a bit irrational, given that the story of Kenya's economic growth is still a puzzle, And additionally, we are waiting for the Q1 and Q2 GDP reports that would give us a clearer picture of the economic conditions. So as of yet, you can say we are still flying blind. Let me move on to the next slide. So looking at the secondary markets, so the market activity slipped 56.2% week to 10 billion. Mostly we attribute this to investors positioning themselves for the upcoming bond. So market activity, just as it has been for the last couple of months, has been focused on the infrastructure bond segment, together with the longer end of the yield curve. For T-bills, they recorded an overall performance of 131.14%, a significant rise from the 66.02% last week. So the total bids received were 31.474, with 31.473 billion accepted out of the 24 billion that was actually being sought by the government. So you could say maybe it could be due to the improving liquidity that we've been seeing. Yields in the discount securities continued going up, with the 364-day T-bill edging up 14 basis points week on week. Moving on to liquidity trends. So the market signaled some easing liquidity during the week. So the interbank lending rate, the rate that banks used to lend to each other, it fell by about 20 basis points to an average of about 4.3%. This is down from 4.92% the previous week. In terms of open market operations by the CBK, it was active, mainly mopping up liquidity. That was about 75 billion during the week, just going to show that liquidity has been easing. We anticipate also the liquidity levels to improve, because this coming week, there are coupons being paid by the central bank for about 5 bonds. So this will inject some new liquidity into the financial system. So from our estimates, the net local borrowing is about 285.7 billion, equating to 43.4% achievement so far. For the macroeconomic and FI calendar, on 10th is going to be the November primary bond auction date, and on 11th, it will be the 91-day, 182-day, and 364-day T-bill auction date. So moving on to the fixed income trade of the week. So the government is seeking to raise 50 billion in this primary bond issue. So it's going to reopen FXD1 2019-20 that has a tenor of duration of 17.5 years, and a new issue that's FXD1 2021-25. It's going to be for 5 years. So just the nomenclature, FXD1 is a fixed rate bond. First one, 2019 means the year 2019. 20 is the tenor of the bond, so 20 years. So the new 5-year bond will have a market determined coupon rate, whereas the reopened FXD1 2019-20 has a coupon rate of about 18.73%. So in our view, we see that there will be heightened subscription in the shorter term paper due to the preference by banks and insurance for these tenors. So the CBK has offered both a long-term and a short-term paper, just to cater to the varied preferences by investors. So maybe during the year, the CBK has been offering longer-term issues just to lengthen its local debt maturity profile, as laid out by its 2021 medium-term debt management strategy. So this primary bond sale is coming after the reopening of 3 bonds last month. That was FXD1 2013-15, FXD3 2019-15, and FXD1 2021-25. So we note that this one for this month, there's only one IFB maturing on the 22nd of November, and there's no fixed rate fixed rate bond maturing in this quarter. So we can safely assume that this 50 billion is being raised for budgetary support as stated by the government. So just to note that some tax consideration to take with these 2 bonds. So the FXD1 2021-005, it has a withholding tax of 15%. That's mainly because it's less than 10 years. FXD1 2019-20 has a withholding tax of 10%, and that's because it has a duration of more than 10 years. For IFBs, that's the infrastructure bonds, remember that they are tax exempt. That's why they are quite attractive. So looking at the, let's say the ranges for FXD1 2021-005, it's 11.35 to 11.5%. For FXD1 2019-20, so it's from 13.2 to 13.425. Actually, sorry, it's supposed to be 13.3 to 13.425. Sorry for the typo. So I'm going to hand it over to Wesley to take us through the equities bit.
Thank you, Melody. Good morning to you, and thank you for joining us this morning. Cautiousness persisted in the market as signaled by the benchmark indices week-on-week performance. The Nairobi Oil Share Index gained 3.9% week-on-week to settle at 170.9 points, while the NSE 20 Share Index shared 60 basis points, closing at 1948.87 points. That said, weakness in activity persisted with turnover still on average. To be specific, the market turnover declined 5.5% week-on-week to 1.4 billion. Looking at the gainers and losers, Kabasi led the pack of the week's top performers on 13.5% week-on-week rally. Kenya Power, Cables, Egads, and Sanlam gained 11.1%, 10.2%, 8.3%, and 7.8% week-on-week respectively. On the flip side, led the week's laggards, shedding 9.1% during the week. BK Group, Stanbic, CFC, and Liberty followed, shedding 8.6%, 7.5%, 6.3%, and another 6.3% week-on-week respectively. Looking at foreign participation, foreign investors accounted for 54.8% of the week turnover. They sustained a bearish outlook, exiting across key stocks to clock a net outflow position of 29.09 million. Looking at our sub-Saharan peer review, the Nairobi Oil Share Index did below its select peers on a week-on-week median comparison. The market's price to earnings ratio was above the African median multiple of 9.7, while its dividend yield was below the African median by 160 basis points. On the corporate calendar, on top of Safaricom's half-year results scheduled for Wednesday, the book closure for Kabasi's 1 shilling and 60 cent dividend will be on the 26th of November, and we shall notify you of Kenyans when we touch base with the management on the same. To you, Melody.
Thank you, Wesley. So we're just going to have a brief overview of the financial market highlights. So as Wesley had said before, BK Group led the laggards in the banking sector stocks with a drop of 8.6% week-on-week to close at 26.5 shillings. So when we look at the prices, it's still in the range of where it has been trading. So we're just going to see how it performs next week because it had released its results on Friday rather. So the other stock that has gone down was Stanbic Bank, as Wesley had mentioned before, from 94 shillings to 87 shillings. Still, it's within the trading range that it has been trading. It's within the 52-week range that it has been trading this year. The top gainer was I&M Bank from 21.45 to 21.75. That's a 1.4% week-on-week rise, with a 0.5% week-on-week rise in ABSA from 10.2 to 10.25. For the insurance stocks, as we've seen, they've been largely going. There's been largely declining. So the largest decline was by Liberty and CIC at 6.3%, as Wesley had mentioned. Jubilee went down 4.5% week-on-week to close at 343.75, and Britam to close at 7.82, a 1.8% week-on-week decline. Kenya Re from 2.42 to 2.32. That's a 4.1% week-on-week decline. However, Sanlam went up 7.8% from 11.5 to 12.4. So for all these companies, we haven't seen any market moving news per se. So you can just say it's range-bound trading at the moment. So some key highlights. So the key framework is ready for sovereign green bonds for Kenya. So it was reported in a business day, in a local daily rather, that Kenya has a green financing framework that would facilitate the issuance of a green bond. So the framework has already been reviewed and got a medium green score, which will allow Kenya to offer the bond and bring on board the private sector to support climate financing. So this was apparently a statement that was made in a virtual forum dubbed Opportunities and Challenges for Sustainable Green Finance, the case for Kenya. So we note that just earlier, I think 26th of October, the World Bank had announced it was giving Kenya a loan of about 150 million just to go towards mitigating climate risks. Secondly, the CMA, that's the Capital Market Authority, published its Q3 Capital Market Soundness Report. So it stated that the domestic capital market remains sound during the quarter, mostly supported by positive investor sentiments and economic recovery. Also, the enhanced vaccination program that's going on and the gradual reopening of the economy. So looking at the equity markets, it sustained low volatility in the third quarter, with much of the activity attributed to the large cap stocks, mostly the telecommunication, banking, manufacturing, and allied sectors, coupled with the increased investor interest in fixed income instruments. We've seen that during the financial year, mostly the bonds have been oversubscribed when there was heightened liquidity. So the NSE share index marginally dropped 0.31 in the quarter compared to 0.34 in the previous quarter. So they also note, like in its outlook, the CMA noted that the heightened political activities in the market as the country goes into gear for the 2022 election may give investors negative sentiments, and we might see people adopting a cautious wait-and-see approach, which may hamper investor interest in the markets. Additionally, in case there's another outbreak of COVID, like another variant outbreak of COVID-19, the socioeconomic disruptions, like we've seen things to do with curfews and lockdowns, can be a key risk due to the reinstatement of these containment measures. Thirdly, a tax bill has been published in a bid to cut fuel expenses. So the Parliament has published the Petroleum's Product Taxes and Levies Amendment Bill 2021 ahead of its plans to lower pump prices when the House resumes sittings tomorrow. So the objective of this bill is to review the taxes and levies on petroleum with a view of making the product cheaper. So the global prices have been on a rise and in the recent months, and hence to bring the price of fuel down, there's a need to reduce the taxes and levies. So the board, the bill proposes that there'll now be required approval to withdraw from the fund and also to impose conditions for any use of the expenditure in the Petroleum Development Fund. They will appoint a board as well. Also, there's the issue of reducing the levy from 5.4 shillings on petrol and 2.9 shillings on diesel after revoking the Petroleum Development Levy order. Also, they also propose to slash the VAT rate for LPG gas. That's from 16% to 8%. So if you want to have a more comprehensive look at this bill, it can be found on the Parliament's website. Lastly, the banking sector earnings season has begun. We saw that BK Group set the ball rolling last week after it released its Q3 results at the tail end of the week. So it had reported a profit before tax of 6 billion, up 33% from the previous year. So the CBK, or rather the Central Bank of Rwanda, has given the group a green light to pay the 2019 dividends during the week. So the National Bank of Rwanda had made a decision in 2019 to defer this dividend distributions so that it could help banks to maintain their capital and liquidity buffers. So this is going to apply to the shareholders who had shares during that period before the book closure in 2019. So on the local front, Equity Group is releasing its Q3 results today morning. I think it's still ongoing at the moment, but just looking at just a few key highlights, the profit after tax has gone up to 36.6 billion. That's about 94.3% year on year. And its loans have gone up 23.2% year on year to 55.9 billion. So we will have a comprehensive look at it later. So I think that's it from my end. Wesley can take us through the trade idea for the week.
Thanks, Melody. Our risk on trading idea for the week is accumulation on Safaricom. Against our half-year estimates, we project a solid top-line growth driven by investor revenues, coupled with a sustained performance by mobile data revenues and fixed service revenues. On a week-on-week comparison, the price function shed 6.06%, and we believe it is in line with the escalation of the political risk in Ethiopia and the possible impact it may have on the venture, which is set for next year, in terms of scheduling and the ease of securing loans to finance the venture. That said, we hold the opinion that the market will allay the risk exposure that it has been pricing in the past week in favor of the half-year results, which are coming out on Wednesday, implying that investors who accumulate may benefit from a potential capital gain in the near term or a fairly priced deal in the mid to long term. That's our trading idea. Back to you.
Thank you. Back to you, Dora.
Thank you so much, Melody and Wesley, for the insightful presentation and bringing us up to speed on the latest financial news. So currently, we don't have any questions on the Q&A. So please, participants, if you have a question, feel free to send in. We will answer it live. In the meantime, Melody, Wesley, if you have any parting shot as we await to see if we have any questions.
Just to comment, we have our very able Ian Wahenya who can answer any question you have on fixed income, on bonds rather.
Wesley?
From my end, is just to thank you for setting your time on a Monday morning to join us and being a family. Thank you.
So we just got in a question from Cliff Mayaka. He wants to know, what is your take on the Uganda MTN? Anybody? I know we've mentioned this a few times in the past. Maybe we just go through it once again for the sake of Cliff.
Yeah. So we had said before, we are not it's not in our coverage. However, what I can do, I can give you the key investment considerations and the key risk factors. So we don't have a target price that could enable us to tell you if it's a good buy or not, but we can just tell you the factors to look at before you make the choice to invest in the MTN IPO issue. So mainly if you're interested in investing in a tech company, this can be a good opportunity for you. But at the moment, we don't have a price recommendation. So we unfortunately can't tell you if it's a good buy or not. So just looking at the key investor consideration. So one is the strong shareholder support. So since entering the Ugandan market, MTN Uganda has benefited from its group relations and Pan-African network. So it's innovation, technology, all that. It has the support of its parent company. Also the financial performance and operational performance. So it's been doing quite well. Also, it has a very large market share of about 59.1%. And given that there's some two providers who are going to exit the market, it might give the company the opportunity to acquire a larger market share. And also, it's positioning itself for the future. It's going to spend about 1.08 trillion Uganda shillings in the next financial year, mostly just for innovation and investment. Though those are the key, you can say positives, there are also risks. One is the regulatory changes and operations. So MTN is expected to maintain compliance of its obligations for its two regulators, and it faces certain risks associated with the mobile banking business. And so they might find this additional licensing, additional reporting or pricing or control requirements, or it can limit the company's flexibility to design new products. There's also the issue of system and network interruptions. So technology networks usually face the risk of technical failures, human error, aging infrastructure, and just other unforeseen interruptions that can come up. There's also the variation of revenue growth pattern. Even though the company is growing now, it might face, this is just a possibility, it's not like a confirmed thing, but it can face, because of the trends that are going on demographically and internationally, you might find that the revenue may decline, or this might be compensated with growth in other revenue streams. There's also the issue of competition and disruption from non-traditional operators. Also, there's the issue of low liquidity, as I'd mentioned before. The MTN Uganda shares on the Uganda Stock Exchange at times are affected by low liquidity for shareholders who want to exit. So you see, like for BK Group, they're listed in both the Rwanda Stock Exchange and Kenya Stock Exchange. So because the Kenyan side is more active, you see they have that option of transacting on our side. But for the MTN IPO, it's just being traded in Uganda. So that's one factor to consider. So giving a price range, unfortunately, we can't give at the moment, but those are the things that you should keep an eye out for when considering to invest in this MTN IPO listing. Hello? Hello?
Sorry, Ian, this is your question. Melody, we can hear you.
Okay.
Hi, everyone. Thank you so much, George, for your question.
Ian, if you could please answer George, if you have any intel on the Rhodes IFB.
Thank you, Dora, for that question. Well, there was a proposal by Kura, the Kenya Roads Authority. They had proposed to float a parastatal bond that was around in 2019, but since then that has not been possible. So last week they published, it was actually in Parliament sometimes back, and they were suggesting that they will now issue it in terms of an IFB, not in terms of a parastatal bond as it were back in 2019. So I think the advisors, with the collaboration with the other stakeholders, they agreed to issue it as an IFB because of the investors' confidence. But yes, they want to raise 150 billion, but that is not sure yet. We still do not have that sacrament of confirmation. In as much as the PS, he appeared in Parliament some 2 weeks ago and said that the plans are actually underway and they might be issuing the same in December, but that is not confirmed yet. So until maybe when we get to the end of this month, maybe the last week of November, once we see the kind of prospectus that will be released, once the MLF starts the Market Leaders Forum, let's see what they are going to advise. But up to now, those are just speculations because we're not really sure whether they are going to float that particular bond in December. So yes. Dora.
Thank you, Ian. I think Dora might have dropped off.
All right.
So there's another question. Hi, it's from Alan. Hello all. Is it possible to buy East Africa country bonds through Genghis? Ian, do you have any comment on that?
Well, currently at the moment, that's not possible, but we can link up anyone who wants to buy the East African bond. So you can just contact us, but not through Genghis as at the moment.
Thank you, Ian.
I see Dora is back. Good morning, everyone. Dora, good to see you. I don't have to hop in.
So sorry about that. I didn't know where we left off. We were tackling George Macquarie's question, then we moved on to the next.
Yes, we've tackled the three in the Q&A.
Also, we have no more questions in the Q&A from my end. So we have one question from Joseph, it just came in. How do you think the expected rise in inflation is likely to affect the bond valuations in the medium term?
I think Ian can assist us with that one.
Thank you for your question, Joseph. Well, in the medium term, we will not see so much of changes, because what we have seen, what the government has been doing, is that they have been issuing the papers that have been issued even this year with the rise of inflation in our country. They have also been closing bonds that have very high coupon rates. So this is to compensate for the rising inflation that we have in the market as it is. But in the medium term, yes, it will be affected in terms of pricing. We will see maybe the prices are going to rally so much. That is, the bonds will get a little bit expensive, even in the secondary market. But it will not be as significant as it is. Yes.
Okay, thank you so much, Ian. I don't think we have any more.
Yes, I think Dara might be having a bit of network issue. But, thank you everyone for making the time. Thank you, Ian, also for your assistance.
I don't know what's happening.
Hi, Dora. We lost you for a bit.
Can you hear me now? Sorry about this. I don't know what's happening today. It's just one of those Monday mornings.
It's a Monday. Oh, there's one more thing I can comment about before we go. So the US Federal Reserve have said that they're going to start tapering its bond purchases. So that means that it's going to slow down the pace of its bond buying program in the next year or so, and eventually to leave the financial market to their own devices. So they are waiting for better job growth numbers so that it can raise interest rates. So at the moment, they're not raising the rates. So we don't expect it to have a major impact on our stock market as yet, because the inflation is going up, but the rates aren't going up in tandem. So they're going to look for places where they can find some return. So we might expect them to stay a bit in our markets, emerging markets, but when now the interest rates go up, we might see a bit of a shift of capital from here back to their home market. Yeah, I think that's it from my end. Wesley, do you have anything else you want to add?
Nothing from my end.
Thanks again, everyone. Ian, Damaris, Daniel, the background Dora, and Wesley. And thanks everyone for making the time.
All right, then. Thank you so much, everyone. Let's meet next week, Monday, for our countdown to the end of our sessions. Have a good day.